I looked at the implications of a potential significant tariff increase by 10 percentage points on all U.S. imports and what that might mean for inflation, growth, and monetary policy, both in the U.S. and in Europe. And the bottom line is that it could create a significant amount of divergence for monetary policy because the inflationary effect is going to be more visible in the US. That's where the tariff is concentrated. But the growth impact could actually be more pronounced, negative growth impact could be more pronounced in Europe because we find that trade policy uncertainty has more of an impact on European investment and therefore European GDP. So the upshot was, while I think there's a good case for interest rates to come down in the baseline in the euro area as well as in the US, this could maybe further support the case for cuts in Europe, but keep the funds rate somewhat higher.
Do you think that the ECB will have enough power to do it on their own, to keep on cutting, whereas the Fed might not be able to cut?
I think, well, first of all, our baseline is that there will be a cut in the US, and we're looking for the first one in September. Of course, that is going to depend on the data. It's going to require continued friendly inflation numbers between now and the September meeting. If that doesn't happen, I think it probably wouldn't be welcome for the ECB, but at the same time, I don't think it would prevent them from continuing to go at a gradual pace every other meeting. I think the fact that there's been some deceleration again in some of the European indicators probably also pushes in the direction of them continuing to go.
Yeah, let's talk more about political risk, because clearly we have election risk very pronounced as well in the euro area, with France coming up next Sunday. Are you concerned about more wobbles in the bond markets?
Well, that's obviously a risk in an environment like this one, where it's very hard to predict what happens in the second round. I think markets have relaxed a little bit post first round. But a hung parliament still seems very likely, and how that exactly plays out in terms of economic policy and passing a budget is still to be determined. So it's natural that the bond markets are nervous around this. The other thing is political uncertainty can also weigh on economic activity and dissuade firms from investing. And if so, again, to me, that feeds into the case for interest rate cuts by the ECB to support economic activity at the same time that inflation is still trending lower.